Thanks for joining us. Yes, we're doing the download on debt today. Thanks to our amazing panelists. I can't believe this is now the fourth of the Enduring Planet community series that we've been hosting. So check out the Insights blog for all our past ones. As many of you folks know, I'm Hannah Friedman. I've been a climate venture investor and a strategic finance strategic finance advisor. I've been working with a number of companies that are building their first commercial scale projects. Most of you have seen me as a venture partner at Planeteer Capital, but recently I've also been wearing some hats, picking those projects from the Mark One platform, a developer as a service for first of a kind, and debt for many of those companies that I've had the privilege of interfacing with and that all of you are building. Debt is often touted as this kind of holy grail for scaling in some ways, and plenty of the equity holders and founders understand that it's non-dilutive. But with plenty of consistency in received revenue and cash flows, there are certainly real opportunities to take advantage of that debt. And so we're going to break it down today. We're going to demystify some of these terms about it. We're going to, whether you call it debt or leverage or credit, it's certainly no monolith. And who better than these fantastic speakers to give us its different flavors? We're going to talk about where to find it, the terms it comes with, and its risks and opportunities. So, Chow, take it away. Let us know what you're working on.
Great to be here with you all. My name is Shao. I'm a partner at Lower Carbon Capital. We love anything that helps solve the climate crisis. I'm a founder first. Built a couple companies in the past. I'm zealously supporting early stage founders and obviously have had my own ups and downs and experiences with debt. Happy to share any insights here. The one thing I would add is I would just encourage you guys all speak up, ask questions if we say anything interesting. Like, this is really your time, right? If we talk about boring stuff and no one gets anything out of it, then, well, everyone wasted an hour and that'd be a damn shame. So like, let's really, really make this time special.
Incredible. Luke?
Hey everybody, I'm Luke. I'm with Camber Road. We are a equipment financing firm. So excited to chat about what that means, kind of what that is, the types of companies we work with, the types of hardware and equipment and CapEx projects that we're financing, all the way from a seed or even a pre-seed stage company to, a post-IPO. So really wide range, and then how we sort of see us fit in the capital stack, working with Austin and working with Shao, and sort of where our financing can kind of complement other areas in the whole capital stack.
Incredible. Dimitri.
Hi.
Partner in crime.
Thanks everybody for being here. I'm Dimitri. I'm the co-founder and CEO of Enduring Planet. We are the Enduring Planet of Enduring Planet and Friends, who organize these events every month. We provide a mix of working capital financing, so corporate debt, and fractional finance services to climate companies. So we have done over 60 transactions now, lending to climate companies, primarily against government contracts, but also term lending and other forms of credit. And then on the CFO side, we serve about 30 companies across stages from pre-seed through Series A. Hardware, software, doesn't really matter. If it's in climate, we'd love to work with you. And we do these events every month. Most of them are virtual. We will have a big event at SF Climate Week, which is still to be announced. We'll have another big in-person event at New York Climate Week, but these will continue. And the next one will be in partnership with Oric, and will probably be about legal stuff, but TBD.
Incredible. And last but certainly not least, Austin.
Hey everybody, Austin Badger. Nice to connect with you all and excited to chat on this panel. So I have been in and around the hardware, climate, frontier tech, whatever you want to call it, space for the last 15 years. And at HSBC, I'm running our climate and frontier tech practice. HSBC kind of came about as an innovation banking practice 2 years ago through some of the challenges that happened in the regional banking industry. HSBC acquired SVB's international assets that very first weekend. And then 43 of us lifted out to kickstart the platform in the United States. We are now up to 120 folks. We've committed about $2 billion in capital to our venture debt strategy, and we have $1 billion commitment to early stage climate tech for venture debt. So excited to talk about how we've been deploying that, how we can deploy it, and kind of what we're excited about for the future of capitalizing these companies.
Incredible. Such a heavy hitting panel of debt dudes and dads, if you will. So give us the spectrum here. Talk to us about credit. And Dimitri, I'm coming to you from the education side, like on and off balance sheet. Give us some of the broad strokes of the flavors here.
Yeah, I think, you started to sort of break it down. So credit can come in different forms and also at different parts of the business. I think today's focus is really on sort of corporate on balance sheet debt. You can also have off balance sheet, which could be usually in a separate entity that holds assets and the loan is to that entity. It can be project debt. But today's focus is really on that sort of corporate on balance sheet. That debt can be against cash flow. It can be against assets. There usually needs to be a very clear form of repayment that comes, and the debt can have lots of different structural elements. So it might be entirely non-dilutive, as in there is no equity participation. There might be warrants or a conversion component to it. Sometimes some lenders actually do both debt and equity at the same time. And then I think the other big distinction is debt can be either market rate or it can be concessionary. And this is where a lot of folks have a hard time. We actually did a whole session on the cost of capital in climate tech, because often people come to us with very skewed perspectives on what money actually costs. And so everybody in this room, I would argue, is a market rate lender. Well, not Joe, because he does equity, but he's going to talk to us about his experiences with market rate debt. But there are some sources of concessionary credit available in the climate ecosystem, primarily from family offices and private foundations. But there are some folks like Lacey's debt fund lends at sub-market rates because they use concessionary money to do that lending. So yeah, I'll stop there. But one thing I will add, that housekeeping wise, as you have questions, drop them in the chat. Don't wait, don't hesitate. Please don't go off mute, because that can be a little disruptive. But feel free to just drop questions. And in the past, we've actually had kind of the audience also engage. So if you have a good answer to it, feel free to answer. And then we can argue in the chat.
Yeah. Thanks for starting it off so strong, Dimitri. I just want to add, a lot of times founders only see debt as the financial part of it. And that's, of course, absolutely true. And we'll get into the details about what it means financially. But if you're a startup, and especially if you've raised institutional capital, debt can also be a really, really powerful signal for the maturity of the business and the maturity of the technology. And sometimes raising debt is in itself a symbol to other investors in terms of how developed your company is. You're selling a new hardware product, you have a new business model. Debt is a signal that almost it's become boring and de-risked enough that someone will give you money. And oftentimes figuring out what are the rates and what are the structures that you can actually take on debt is a huge positive signal for your business overall. And so it is also used as that marker.
So well added. Thank you. And let's tease apart something that was embedded in Dimitri's language, which is like debt can be against cash flows. Debt can be against your equipment. Debt can be against. What does against mean in this context? And Luke, I'm going to come to you. Talk to us. What is secured versus unsecured debt, and how do you look at that at Camber Road?
Yeah, good question. So, secured debt is going to be secured by something, right? In our case, when we're doing equipment financing, we are using the equipment, the hardware, the CapEx, whatever it is. I usually say we finance stuff, because it is a really wide range of what it can be. But the stuff itself, that will be the collateral. Unsecured, right? Austin, I'll maybe have you touch on the unsecured side of it, right? But that's really usually going to come from a bank. It's not tied directly to an asset. It's not tied directly to some piece of collateral, but it's more looking at the cash flows of the business. It's looking at the cap table, the equity, stack of it, and the other, basically the nuts and bolts of the business, not something that's so specific to one piece of equipment, right? And I can, dive into this in the future and kind of as we kind of go along throughout this session here, but where equipment financing and the way that we structure at Camber Road is we're using a lease model. The reason we do that is, one, because we think it makes most sense with the optionality at the end of a lease. You can continue to use the equipment, you can purchase it, or you can send it back. We're working with growing companies where, 2 to 3 years from now, they don't really know all the time what the equipment's going to be useful for, how long it's going to be useful, technology changes. But another main reason we do it is we don't have to then be a subordinate lender to a senior lender or to Austin. It creates a very simple capital stack on the debt stack. Sometimes we're not even considered true debt because we don't have to be one of those senior lenders. There's not a lien into the company. We just have a lien onto the asset. And so there's unsecured and there's secured, but there's also secured by a lien into the business, or is it just a lien into the company, right? Or just into the equipment. And we're just a lien onto the equipment. And so it's another way that, there are, to Xiao's point, we are a part of the capital stack where we can actually be hopefully helpful on the equity side as well. If a company is saying, hey, we're going to raise from, XYZ investors, we already have a non-dilutive partner that's going to help on the hardware side and a senior banking relationship or a senior debt relationship on this side. And that kind of rounds out the capital stack. That's where we can really be impactful, not only on the debt and the financial side, but also, as we all know, over the last couple of years, the market has become pretty difficult out there sometimes to raise. So finding that useful and creative capital stack, we can be kind of a part of that as well.
That's so
Yes.
meaningful. Go ahead, Dimitri.
I was just saying, it's always good to see Luke involved early. Like, it changes the dynamic from having to raise like $40 million and then buy a lot of hardware versus like, hey, we're going to raise like 20 to 30. And then like Luke can come along, and it also signals that, hey, you're buying off the shelf stuff that actually has intrinsic market value that someone will finance against, right? These are all things that enhance the story. And if you can get that locked in before you're knee deep in a raise, wow, the storytelling really reaches that next level.
Super valuable. And like the signaling you've been describing, think about, for these founders in the room, think about it as like votes of confidence, right? And like they come at different levels. Like if they're secured against equipment, it's like, cool, that equipment is valuable. If it comes unsecured against other liens in the company and the cash flows, then it's like, that means that someone else took a vote of confidence to say like, yes, I see that trajectory too. Yes, I was brought along in that intellectual journey. But a lien and the collateralization there, Austin, tell us a bit more about like, what does a lien mean and what does subordinated mean? Like when we talk about that capital stack, how does this debt interact? Define those two terms for us and tell us a bit more about the venture debt strategies that you take liens and subordination on.
Yeah, happy to talk about that. So from our position, a bank is senior secured lien. The more detailed description of that, I was just making sure with my AI, was UCC1 liens, which is Universal Commercial Code, which I don't really know the details there. But a UCC1 lien is something that's filed that effectively validates where HSBC or your venture debt lender sits in the collateral stack. The only institution that is UCC0 is the US government, which sometimes you'll hear why it's difficult when you have a government contract or things, why banks have a challenge collateralizing against that. The idea there is that the venture debt is a very flexible tool. I think from our perspective, it's a relationship between us, the company, and the board as it relates to your use of that capital. So we tell people, like, technically speaking, you can use venture debt for a holiday party. We don't suggest it unless you are celebrating a big fundraise. But really where we see its most notable use is when you have a significant milestone or something that you know will be enterprise value creation for that next fundraise, and being able to leverage the debt to either negotiate the terms for that next fundraise or be able to kind of stretch the business into that milestone and ensure that you've achieved it before going to market. From our perspective, there's three elements. It's the interest rate, it's the warrant, and it's a banking relationship. So a little unique to banks when you think about venture debt is that we are asking for a banking relationship with you as well, which is why we can bring down our cost of capital so much compared to a debt fund, which happy to talk about that, but that is more of a fund-like return strategy where they need to make all of their fund returns just on the debt itself.
Incredible.
I just want to add, so I think, we at Enduring Planet, our capital is very lightly secured. We just secure against the contracted receivables. And depending on who your lenders are, and this is actually something to really be careful of and think about, is if you plan to raise debt from various sources, make sure ahead of time that they play nice together. Because one of the issues we've run into is that companies will come to us and they'll say, hey, we need additional liquidity. We want to finance against this government contract. And we're like, great, here's a term sheet. They're like, awesome, we sign. And then they're like, let us go talk to our senior lender now. And depending on who their senior lender is, they will sometimes say no. And in cases where they don't, what often happens is that there is either a subordination or an intercreditor agreement. So the lenders who are subordinated, i.e. as in lower in the seniority stack, that means that if there is a bankruptcy event, a default event, the subordinated lenders get paid later. It does not mean necessarily that they cash flow after the senior lender, because, for example, in our case, if we're doing a 18-month loan and you have a 6-year or 5-year venture debt loan, we're going to get paid first, but we're still subordinated in case there's like a problem. Okay, so somebody just asked a cost of capital question, which I think is okay if we detour for a second on that.
Absolutely. Let's go for it.
So,
Thanks.
there was recently a working capital post by Sightline, which I think covers some of this. But in our experience, and Austin, you can confirm what your pricing is at HSBC, but our sense is that venture debt comes in from banks at around prime plus 1 or 2. And prime today is what? What's it at?
Good question.
Fluctuates a little bit.
7 something.
7 something. So you're
Yep.
talking about like 8 to 10% for venture debt from a bank. Venture debt from a commercial venture debt lender is going to be in the mid-teens. And that's before all your warrants and fees. So that's just the rate. At Enduring Planet, we lend at somewhere around 15, 16. But that's relatively unsecured debt, which I would argue is actually very cheap. Equipment financing, I think, Luke, you can confirm, but generally like the equivalent IRR is also in the mid-teens, right? Is that correct?
Yeah, it can be. The only caveat is if it's a lease and you don't extend it, it's 0 right there. So that's the hard part about
Well,
it. That's where
but there is depreciation resale value of the hardware asset. So there is an effective cost of capital, right? It's
Sure.
not actually 0 because you paid to use something that you don't own.
Yep. Yeah, but the IRR would be, yeah, exactly.
Right. And then, a lot of startup financing is in the high teens to mid to low 20s, right? So a lot of private debt is actually very expensive. And so I would say like best case, you get venture debt from a bank. And then, there's some additional costs that might be baked into the banking relationship or into the warrants or whatever. And then you're looking at, if a bank will even lend to you non-venture debt, you're looking at low teens right now in today's market, but probably higher. And then it goes from there. Anybody want to add to that?
Just that I love that we've already started to start talking about some of the other terms like warrants and fees. And when I think about like the financing for first of a kind projects that are often in the low 20s or high teens, private credit, they come with also things like ROFRs and the right of first refusals and offers on your future infrastructure projects or project capital that you raise. That's off balance sheet. We'll come back to the corporate debt side. And so this, I think a lot of founders, rightfully so, and from this chat, immediately think of like, can I afford this debt? Can I cover that cost of capital? But there's also a question of like, when should I take on that debt from, even if I can afford it? And I think you're hearing, Austin, I'd love to actually come right back to you on when do you see clients successfully raising that venture debt from you, and really like what needs to be true about their timing there?
Yeah. So the most successful venture debt raise is usually right after an equity round is closed. Most of what we tell folks is you have a data room open. We can literally streamline off of exactly what you use to fundraise your equity. The reason that is helpful for a lot of companies, from our perspective, most of our debt is not actually funded at close, but instead funded right around your cash out date. So we're effectively installing an insurance policy when you're liquid for the preparation for a low liquidity scenario. So the reason it's helpful to do that ahead of time is because your remaining month's liquidity is what we're looking at. In fact, it's what regulators, I can take you down that path if you want, but for them to look at it, under 12 months of runway is actually considered a bridge loan. beyond 12 months of runway is considered traditional venture debt.
Hmm.
They are all kind of the same tool, but it's a timing instance that you have to think about. And happy to talk more in detail about that. But generally speaking, right after a fundraise from amazing firms like Lower Carbon and otherwise would be the right time to start putting that into place to prepare yourself for that potential need down the road.
Just to
I wanna-
add that, sorry, go ahead.
Yeah, go ahead, Joe.
I was
Please.
just gonna add on very quickly, right? Like debt coming from a place of strength with strong institutional investors will get you better rates, faster process, all of the above. It's not so dissimilar to in real life where it's like, oh, I'm gonna, lease a new car and that's gonna help me get to work and that'll give me more money, right? Versus like, hey, I'm gonna lease a car or a new boat or something like that, and it's gonna be like a drag on my financial situation. Those are very, very distinct cases. I'm not personally a fan of people doing bridge loans because, again, going back to the signaling idea, like a bridge loan, that could be a signal of extra risk or maybe even a red flag versus bringing up the question of like, hey, why weren't your equity investors willing to give you some capital instead of having like the debt hanging around your head? The other thing I'd quickly bring up is the players in the space also vary a lot, right? Like if you are like what SVB was traditionally, they care also about a holistic relationship, right? So you can start having that conversation before you have the data room open or necessarily even thinking about your institutional round. That could be a quarter in advance, and they might also give you certain advantages if you also do other kinds of commercial banking with them and other things. So really explore and understand what the other partner wants out of the relationship to get the most out of those conversations.
Yeah, I think that the thing that I would add too, and this is something that we see very often, is that folks think of debt as the last option rather than the first, and I think that's often a mistake. And so, to Show's point, like there's a big difference between credit that is used to support cash flow and a bridge loan, right? Bridge loans come at a time when you are out of money, and they're usually very extractive, very punitive, very predatory, because you're up against the wall and you need the cash, right? It's very different to say, okay, I have an understanding of how cash will flow in and out of my business over the next 12 months. And I may have a low point in the next 6 to 12. And instead of waiting until that moment to go and ask people for money, I'm actually going to raise debt now, improve my cash position so that I never hit that low point, or so that low point comes much later. And I think this is like probably the biggest piece of advice I can give folks, other than like read your terms and really understand what you're signing. But like, don't try to raise debt when you're out of cash. Raise it first and then use equity for that risky part later. And I think that like, as long as you have those receivables and you can borrow and it's at good terms, it's generally the cheapest capital you can access in the moment.
And Dimitri, one thing to even piggyback off that too, it's start the relationship before you even need that, right? Like it always helps us. And I know, Austin, we've had these conversations. Dimitri, I'm sure it's the same with you guys, but you're raising the round. You think you're going to need that. Let's have that conversation early so we can be kind of along the journey for the whole plan. And it's not like, hey, I raised, now I'm going to start, this whole debt process. Like it's completely separate. For the most part, our timing and when we can be the most impactful from an equipment financing standpoint is the same as Austin's. It's following around. It's when your credit's the strongest, you have the most runway. What that means for us usually is we've been talking to this company for 6 months, 9 months, a year, right? In kind of preparation for this, because the only real difference, or one of the major differences, is our financing only comes in handy when, and if you need the hardware or the financing, right? For the equipment. More often than not, that equipment need is actually after the raise, because the raise then unlocks the doors for everything else. And so it's like, okay, we raised, now we're going to go out and buy a bunch of stuff. Hey, here's where we can really help and finance that. But we've started the relationship months prior to kind of have that plan all along. And sometimes there's even, contingent term sheets where it's, hey, if you raise this, we're going to, have this in financing, which, Sean, maybe you can touch on like how that can be impactful from an investor's standpoint as well, get more comfortable on the equity side. But that relationship stuff really matters, and starting that earlier rather than waiting all the way to the round to close. And then, basically, okay, now I'm ready to move on. It's like, no, they all kind of harmonize and come together, and starting them earlier is almost always better, especially the way that, we look at it and other folks in the debt market kind of do.
Excellent.
Yeah.
And underlines Martin's question here in the chat, which is like, how often are you kind of looking for pre-existing relationships between those lenders and equity providers? And frankly, they often already exist. And I think that's been increasingly true, not just with events like this, but like the work has been getting done together. And you should absolutely expect, when you're talking about building this momentum and sharing this cross-pollination, starting the conversations early, do not oversell them. They will pick up the phone and call their friends at those entities or lenders and see what's up. And likewise have like actually been asked verbatim by my portfolio company's venture debt lenders, are you going to continue to support this company and what milestones need to be true in order for that to be successful? And so you're building a house of cards story that needs to stand and check out at every stretch of the word. We've talked a lot about that early part and getting it built out of relationships. If you don't have someone on your team responsible for that, if the CEO is not prioritizing that networking and relationship build, you probably should. And you probably should work with companies that are well connected, like a Dimitri or others, or Xiao, who knows folks in these industries and can help you accelerate that relationship build. But I want to talk a little bit about like, when is it contraindicated? When might debt not be the right thing? And you still are building the relationships, but you might not be prioritizing the execution of that strategy. Xiao, I wonder if you might share a little bit of your opinion on this.
Yeah, I think there's two things to bring up. First is just going back to this idea that like debt by itself isn't like really anything. There's a lot around, is the team ready to do the kind of more advanced financial planning and discussions in order to actually service and actually hold the debt? And it's that kind of level of discussion that we always have at the board level per se, that gives us a good indication that, okay, here's the team that's ready for debt. Almost always, that's also linked to the debt clearly being an accelerative force for the company itself. Hey, taking on this debt enables us to order all these components right away, right now, without compromising our long-term growth and our runway. And this means that as soon as those machines come, we can deploy them at a customer site, and that actually leads to revenue, and then the revenue goes back and circles the debt. And so what you're building is a very comprehensive plan that's shaped like a circle where you can connect all those dots. And usually the conversations that the investors want to have is, okay, we understand the timing really, really well. Here's when the debt kicks in. Here's where we're going to draw on it. We order this. It comes 3 months later. And then at this period, we have to commit other kinds of capital. And then finally, the customer pays us. And the more that you can articulate that full circle in a comprehensive way, I think the people who give you the debt will be happy. I think your equity investors will be happy. And I think the overall shape of the business will be more healthy if that's the case. If you're not doing it for those kind of reasons, I think it's much, much harder to justify.
Yeah, I think I would add here that like debt needs to serve a purpose. And so if the purpose is something predictable and the outcome gives you enough cash flow to service your debt, then it's worth considering debt, right? So for example, if you're like, oh, we're gonna launch this new feature of our product, and we think it's gonna generate 5 million of new revenue. We're gonna borrow money to do that. That's a terrible place to raise debt, because you have no clue if that feature is actually going to do anything. But if you have a big contract with Mercedes and they're going to buy a bunch of your stuff and you just need to build it and the performance risk is relatively low, that's a great place to use debt. I think, Austin, you might want to comment on like when it's a good idea to raise venture debt, because just because you just raised a round doesn't mean you should necessarily raise venture debt, right?
Absolutely. Yeah, I think from our perspective, and kind of what you're hearing from everybody here, is that the more tailor fit the debt is for a purpose, the more comfortable everybody around the table is for that use. So venture debt is very kind of loose by design, but the only thing that we do, the only due diligence we do when it comes time to funding it, is calling your board and saying, is there a strategy for the use of this debt? Do you agree with the funding of it? Does it accelerate the capital need or the velocity of this business? And so, yeah, the more structure we see around those things, we've talked, Luke and I, we've gone deep on hardware as a service or other things that are actually capital consumptive things. Banks love financing that because we know on the other side, there's more enterprise value. More enterprise value, you either have access to equity or you have cash flows. there's a lot of things you can do on the other side of that capital infusion, versus kind of a, you know, I think like a Hail Mary type of financing. Your board's probably not going to be very excited about saying yes to that either. Venture debt is relationship based by design. Those VCs have a portfolio that they're representing as well. They have a relationship with the banks and the funds that are around these deals. They know that there's a lot of, you know, kind of on all of our shoulders when we start putting large amounts of capital to work.
Excellent. In summary, debt is purposeful. Debt is not Hail Mary life extension for continued hypothesis testing. So jet fuel, you got to have a working jet engine.
Yeah.
I think like what is so powerful in that is it requires an element of listening to that ecosystem, listening to your equity advisors, and listening to what those debt providers need in the process of making that purpose capital P for them and for their investors and everyone that they're justifying it to. So you can get that stamp of approval, you can get that signal when you want it. When building relationships with lenders, you know, they say if you want to raise money, don't raise money. You should ask for advice. Like, don't ask for money, ask for advice. Dimitri, I see you like jumping out of your seat here. Chime in.
Yeah, I just wanted to say something maybe a little spicy in response to your comment about asking for advice, and who you talk to for advice. So, and this is also like maybe a response to Show's point about why didn't your equity investors just fund that thing? So, sometimes you have to understand that there's different things that factor into how people give advice. One is whether or not they understand credit, which we found a lot of equity investors don't. And also what the incentives are. So if you go to your equity investors and you're like, oh man, I have this big contract, I need 250 grand of free cash to navigate it, they're going to be like, sweet, allocation. And that might not be the best form of financing for you. Now, it might be. It might be that the debt, the servicing cost is too high. It might be that it has terms that are scary, right? Like whatever it is, but just be mindful of who's giving you advice, how informed they are, and what their incentives are. And if you're doing that, then you're doing a great job as a founder. And it's not that like debt is always great. Sometimes it's not. But sometimes the people telling you whether it's a good or bad idea don't have the best interests of the company at heart, because sometimes those are actually vague or counter to one another.
Absolutely. And so therefore part of that mitigation for you as founders in this room is like you need a diversity of opinions and you need a diversity of input, and therefore your mode of soliciting advice should be more interrogative of like, what do you need? Why do you need that? Where are your incentives? How do you see this playing out? What should I be watching out for? Those types of questions, and asking for advice in understanding who your counterparties really are. They are, we've talked about this a lot, to preserve optionality, which is one of the key ingredients to success along the way. You have to treat your investors and your shareholders with the same level of discovery that you treat your customers. And so on that vein, and to accelerate your learning, I want to come to Austin, Dimitri, Luke here about like what you're looking for and how you underwrite risk. So maybe we come to you first, Luke. What are some of the risks in equipment lending, and what are some of your incentives and needs here when it comes to like, you know, sometimes you just take your ball and go home. How should founders think about understanding you as an actor?
Yeah, equipment lending and equipment financing, I think I want to make clear for everybody on the call, it's a lot broader than what Camber Road does, right? We do leased financing for VC-backed kind of growing companies, right? There is equipment financing through, you know, Caterpillar, through vendors. There's a lot of different ways. I mean, Austin and I kind of talked about hardware as a service lending in a way that's kind of a type of equipment lending, right? There's a lot of different ways that you can finance against equipment. The way that Camber Road does it, the way that we, you know, focus on our structure, the lease model really provides the ability to have a lot of flexibility. We can get started a little bit earlier in terms of what are we looking for? What is the credit team kind of looking for? It's really going to be, you know, what does the cash runway look like, the cash flows, right? Who are the investors into the company? We do not ourselves pretend to be investors as smart as our lovely dad joke telling here friend show, right? Like we do not pretend. We follow, right, folks in the market that truly know all of the different industries that we work in. We work in climate tech, we work in biotech, anywhere there's hardware. So we're following a lot of the investors and the experts in the area for them to do the diligence that, hey, this company is going to return, hopefully the fund of the investment from an equity standpoint, but also stay alive for many, many years past what they have currently in their cash flows. Really impactful for us, really important. What the other side or the flip side of our credit decision and kind of what we're looking at, I think that gets sometimes misconstrued is, oh, they must only care about what the equipment is. Oh, yes, of course, the equipment is important. That's what our security and our collateral is against. It's not as impactful as the company, right? There could be something as simple as, a forklift. Everybody knows what a forklift is. Everybody knows there's going to be some value for it, right? But if a company with, 3 months left of runway wants to finance a forklift, it's still not something that our credit team's going to love because they're like, hey, at the end of the day, with our restrictions and the things that we put into our lease, it's I'd say pretty light touch. Our only real lien is that forklift. So if something were to happen and there's a downside scenario, this is where, we use the term take your ball and go home. We try to go get that forklift and make any, sell it to a secondary reseller, but it's not that easy, right? There's a lot more complications than that. There's UCC liens, there's landlords. It's not quite like, hey, we just knock on the door, drive our forklift out of there and, it's all over, right? It's a lot more complicated than that. So we don't want to go through that process. It's not a win for us. It's not a win for the company. So yes, the equipment is very important, but really it's the company and the credit profile of the company that's much more impactful, right? I think where Austin, I mean, maybe you can touch on the hardware as a service and how they're similar but differ, right? We can maybe get started earlier in a hardware as a service type model where it sits at the end customer because it might be a contract, a first contract, second, kind of early on in this company's growth, and the contract hasn't quite been proven out or gotten to the back end of a contract yet. We're okay with doing that. We're a non-bank lender. We have a little bit more flexibility. So we're not maybe going to look at that contract as ironclad as maybe Austin and the bankers, would maybe after you've gone through that and you're a little bit farther along. And then it's like, hey, now you can qualify for hardware as a service financing. And then we sort of work together and we can kind of basically combine our products, and Austin then can take that piece. So it's a lot that we look at in the equipment financing space, but it's not just the equipment itself. It's not just the company itself. It's a combination of both, but really focusing on the company more so than just the equipment is kind of how we look at it in the space.
Incredible. Austin and then Dimitri, give me some of the parameters around how you underwrite those risks. And Austin, like in banking more generally within venture debt and beyond it, like what does the bank need? How are they incentivized? You've mentioned that, a broader relationship across multiple teams, commercial banking or other products is part of that. But how else are you guys thinking, and what do you need?
Yeah. So I think what's really nice is that we're all kind of in the same family here of talking about climate and frontier tech companies too. Maybe my friends who are at HSBC and Enterprise SaaS, like they're looking at your SaaS metrics or whatever, like on day 3 of your company building. What I at least believe is that most of these early stage companies, you are sitting across the table from a founder or investors, but in effect, you are looking them in the eye and saying like, when things get hard, they inevitably will. Like, will this person pick up the phone, have the hard conversations, be willing to go through those difficult moments together? We're all kind of judging each other for that to figure out exactly kind of who's in the boat when things get tough. So I think that's the big one, is like that's kind of our like founder assessment. The other things that we're looking at is like, what is this capital going to do? It's either de-risking the technology or it's advancing commercial application of the business. So some of those things where we're saying, okay, how much capital does it require? Do you have the capital to do those things? And how are we all going to feel once you've achieved the goals that you set out for in the next 1, 2, 3 years? From our perspective, what we're looking for in that relationship is, again, I think you had brought this up earlier, like I kind of call it like relationship currency, and how you building a relationship with a bank is actually a little bit easier. Like you can open a bank account with us. So 2 years ago, when I came over here and I didn't have any clients, I didn't have any, we had nothing. It was those founders that said, "Hey, Austin, let's stay in touch. I'm going to open a bank account. I'm just going to put $1 million in them. I have no expectations. You know damn well that they're going to get a great loan from me when they need it." And so part of it is that. And then part of it is my job is to actually open the aperture of HSBC to deliver interesting and unique value. So we can get a little bit in, but like first of a kind financing, hardware as a service, some of the things that we've been working with this panel on, those are things that require more and more aperture from this bank to be delivering to the companies. And so a lot of my job is, once we have the venture debt or once we have the debt facility in place, like that's when our job starts to say, okay, like I need to now keep you on the platform. I need you to be able to access capital here, 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 and here. And make sure that that's available to the company at the right time. So it's a relationship that we have to do, but I think from my mind, it's actually like they're like kind of kids in a candy store at a bank. Like I have to make sure I'm bringing the right tools at the right time. Or else I failed you in that relationship when we looked across the table.
That's really powerful. And would be hard pressed to find, I think, more innovative bankers. I know it's called HSBC Innovation Banking on the venture debt side, so forgive my pun, but I would say, like, having seen you guys in action, I can underline everything that Austin's describing about that, like, look you in the eye, be solid on the other side of the table. Dimitri, give us the lens from the non-bank, or sometimes called the alternative credit provider, alternative lender. How are they different? How do they think differently?
Yeah, I think in general, we're probably one of the earlier lenders in this room. Like I think we've done some deals where Camber Road is involved, but generally we're coming in before HSBC does. And for us, we're really trying to underwrite kind of two primary risks. So if we're doing our government advanced lending, and even our term lending actually looks at very similar things. One is the company going to stay solvent for this period of time that we are the lender? And because we're often lending against a contract or receivables in a contract, like, will the company stay solvent to get paid by whoever's paying them so that we can then get paid back? And so that generally means that we're, underwriting cash flow, we're underwriting liquidity, we're trying to understand sort of solvency long-term. And then the other is, what are the risks associated with those payments? So in some cases, we'll lend against government grants where it's just a reimbursement model. As long as you're spending against the budget, you're getting paid. Those are our favorite. We can do the biggest advance rate on those. They're the fastest, the easiest for us. And then in some cases, there will be performance risk associated with it, in which case we then underwrite that as well. And we try to understand, has this company delivered on this thing before? If they have evidence of their invoices being submitted to plan, things being delivered to other customers or similar government agencies on time, those are all great data points. And beyond that, like, unlike venture debt lenders, we don't care if you have top tier VCs as your investors. In fact, we have plenty of small businesses that borrow from us. And because we're not lending against your next fundraise, we also don't necessarily care whether or not you can raise the next big round, because for us, what matters is, are you going to stay solvent? But I think, and I don't know, Hannah, this might derail the conversation, but there's been a lot of questions around, like, what happens when shit goes wrong?
Yeah.
And I think it's, that's something that we do try to underwrite a little bit, is like, what is the likelihood that something catastrophic could go wrong in the next, 12 months? But I think in general, and obviously this depends on the kind of lender. There are predatory punitive lenders who will send you a legal notice the moment something goes wrong. But most lenders want to get paid back. And oftentimes that means you have to work with the borrower to keep them solvent so they can pay you back. And so I think a lot of folks are like, well, bankruptcy, lenders pushing for bankruptcy to get their, like, UCC so they can, that happens happens generally in extreme cases, right? What you're trying to do is say, like in our, when we have folks come to us and, they might borrow for the next 12 months and then they're like, oh, my grant's delayed by 3 months. Can we pay you in 3 months? We're like, are you going to be solvent for 3 months? Great. Pay us later. We make more money. Why do we care? Right. And so I think like that's actually a really good question to ask your prospective lender is what happens? Give me 3 examples of deals that have gone a little funky. What did you do? How did you adapt? How did you work with the party? Have you ever taken anyone to court? How did that work out? Like, these are great questions to ask. I don't know, Luke, Austin, and Joe, all of you have probably experiences with debt going bad. Hannah, is it okay if we derail into that direction?
Absolutely. Let's get to the good, the bad, and especially the ugly.
I can jump in from any equipment side here. Dimitri is completely right. We are not begging for the companies we're working with to go out of business so that we can go get our stuff back. We do not want it. We do not have a warehouse that we store all of our equipment in. We want our financing to be for equipment that the companies are using, right? It's pretty simple. So if there is some sort of hardship or there's a situation that we didn't foresee coming, okay, great. How can we help out? Is it, do we take a step down for a couple of months and make that payment lower so that they can get through that time period that's difficult? And then, rent can be extended on the back end when things are good again. We can do a lot of different things to make sure that works. I think we get a lot of questions, Dimitri, when folks and, prospective companies and founders are thinking about working with us, or we're kind of trying to figure out if we're a fit. They'll say, well, how do I know you're not going to come take my stuff? And I'm like, well, one, contractually we can't, right? We're not allowed to just come into the building and take your stuff. But 2, we really don't want to. We work with a lot of companies. I used the forklift example earlier. We also do a lot of custom and bespoke equipment, stuff that might not have a lot of value to, the open market, if you will, right? We definitely don't want to come get that stuff. It is truly for the company that's using it. It's for the company that's using our financing to extend out the runway. So we're going to be as flexible as we can to help that company and make sure that they can get through, whether it's to that next milestone or fundraise or kind of whatever that period looks like. Because I think sometimes it's counterintuitive to think, oh, well, they'll just want to come take the stuff back. It's like, no, we really don't. To Dimitri's point, we want you to continue to pay us monthly through the lease term, because that's the best way for our business to work. And obviously that means we're working with the right companies as well. So that's really the way we look at it is there's not really an upside scenario for us to have to go get any of the equipment or have to go work. It's just, there's zero benefit to doing that. So we're going to do everything we can to make sure that that is the very last resort. And that's usually the founder calling us saying, hey, we can't make it. This has happened. It does happen, unfortunately, in the world we work in. And then we work together on hopefully they're saying like, you've been a good partner. Where can we ship the equipment back to? Those are the ones that we like. It's mutual. It's right. Sometimes it doesn't happen that way. It's a bummer, but we are doing everything we can to not get to that point, because it's a lose-lose for everybody.
Totally. There's a question here about risk controls and the difference between a bank lender and a private credit lender. And I can highlight a little bit that certain private credit lenders they don't have the same return thresholds that maybe that more institutional or commercial lenders have. And so knowing your investor and who they raised capital from is important. But to Dimitri's point, this room fundamentally understands, and I hope the founders hear it plainly, your credit lender, unlike Xiao and I in the early equity spaces, the credit lender does not have a power law. They can't make up return from failed investments. And so that's where this risk aversion comes from. They can't let 1 or 2 portfolio companies go to zero. Xiao and I can't. We can. We're other companies have so much upside that actually 90% of the companies go to zero, and that's okay. But maybe Austin, you could speak a little bit more specifically to like, what are some of the like golden handcuffs that banks might have in this kind of like risk controls space?
Yeah. Well, I think that the thing that is very good to highlight here in a when things go really bad scenario is how fast everybody around the table comes to that realization. So probably the most difficult scenarios is when the founder and the board are not aligned, that things are going sideways. So I'll pull Xiao into for that. But from our perspective, as soon as everybody's kind of like, hey, we need to put a bow on this, like we all gave it our good college try, like let's make the most out of this kind of wind down. I actually think those are, like, Luke, you kind of mentioned it, like then they're shipping the forklift back to Luke. We're like bundling up the IP. We're trying to actually maybe sell the business. Every founder is trying to find a good home for their employees. Like you can very quickly tell. And again, that's probably why most of my diligence is that look in the eye, because in that moment, the people who are like, okay, like we tried, we are a startup. Not all of them work. Not all of them are successful. Like, let's do this right. And I think that is critical. Some of the tools that we have is actually, again, like not everybody goes through bankruptcy. We hope that not everybody on this call gets to experience what we as lenders get to see. We bring a lot of advice in that moment. Who's the best partner to bring in to help you guys wind this down? Should we do ABC? Should we do chapter 11, chapter 7? How do you want to actually approach that? How do we reduce the cost for everybody? And how do all the lenders and board members link arms to say, hey, I got this cost, you got that cost. We want to take it to sale. Do we want to kind of break it down? There's a lot of different decisions that have to be made, and those micro decisions, again, lead to, there's a lot of founders that are repeat founders. Like I can tell you, I've gone through these really hard times with them. As soon as they raise their next, they start their next company, like we're the first ones that we want the phone call from, because like it's only in the hard times that you really get to like kind of show your colors as a partner. If everything is up and to the right as a lender, it's pretty easy to be like, yeah, let's load more debt onto that.
Yeah, it's 100% right. And it's been so well said. I guess the only thing I'll add is to really focus on like how the stuff all goes horribly, horribly wrong. And it goes back to what Austin said so nicely, which usually everyone's on the same page. And where that comes from is a place of deep, open, and honest conversation, a lack of avoidance, strong and powerful lenders and board members who are talking to the founders and being like, hey, like we have to look at aspects of the business that, hey, we might not want to really, really look at. And then everyone comes on the same page. The only kind of like really nasty situations I've seen are where people, for one reason or the other, just simply don't agree that something is coming to an end. And that can lead to kind of a very, very difficult and protracted battle, oftentimes with deep emotional roots, and that's why things kind of go a little bit haywire. If you have and foster from the very beginning that kind of openness and real sense of partnership with your partners, you avoid a lot of the heartache down the road, no matter what ends up happening with the business.
I think a lot of founders freak out when stuff starts going wrong, and they don't want to tell their lender because they're worried about them triggering breach or default provisions.
That's 100% right. Yes.
Which it makes some sense. But the problem is that generally when things start going wrong, it's not just a question of if your lender is going to find out, it's when. And if they find out later, because you avoided the conversation, I really love that, a lack of avoidance, right? Because you avoided the conversation, you're going to be in way more trouble than if you had come out and said, hey, I just want to let you know this contract fell apart. We're not going to get this revenue. Can we start talking about a modification of our loan? The soonest you do that, the better. And most lenders, unless they're shitty people who you should not borrow from, right? Most lenders will work with you because it's in their best interest to get repaid. And sometimes, like, we have a borrower who has had a hard time for a year. They sell into a commodity market and the commodity price went down by like 80%. And they went from having a lot of revenue to having very little revenue. And I will tell you, the relationship would be much better if they communicated with us. And instead it's like, it's strained. And so this is a thing where you really want to be open. And this is why you do the good diligence on whether or not you can trust your lender. And you have these conversations. And then that way you can work on it together. You're a team. In many of the same ways as you are with your equity investors, because you would go to them if you're running out of cash and you'd say, hey, give me some money.
I want to highlight for this room of founders who maybe have never raised $1 of debt in their life. I want to highlight how hard that is to do. because you are unlearning the lessons that have made you successful at potentially raising venture capital. In venture capital, you're selling vision. In venture capital, you're selling what could be, and you're bringing that excitement, and you're constantly selling what's like right around the corner. And I appreciate that it takes so much effort to get into that skill set and to start to believe with dauntless courage what it takes to do that. And what we're asking you to do now, and what we're trying to bring as an early opportunity for that maturity into a debt stack, is the unlearning of those skills into a far more transparent, open, and early about downside. This could go wrong. I could miss this sales contract. I could be late on this revenue schedule. Or is there option to start talking about this early? Like, it is the opposite. And so I'll just acknowledge to the room, like, founders, if that feels foreign, it's because you built all these skill sets to raise equity, and now you're inflecting into a totally new set of skill sets. And it's hard to do with grace, and you can partner with folks like this on the call who have been there, done that, understand it, and you can be honest about those evolutions of your own founding journey. I think that that's what the right partners help you do best. Got to approach that with listening and humility and a lack of avoidance, capital, all caps, lack of avoidance there. In that way, I wanna orient the conversation, because one thing I often find is like, you negotiate the contracts, and there's all these terms, and there's all these conversations you're having about what could happen, and it sounds like, you come to them the challenges of bankruptcy or the challenges of the downside in two places. It's in that contract up front when you're negotiating terms, and then it's when it actually happens. When it's in the contract, it's really easy to get hung up on those scenarios. But what you've heard today is that in the gap between the contract and bankruptcy actually happening and downside protection actually coming into force, nobody wants to see that second stage gate, and everyone's actually on board to help you avoid it. So in the contract, don't make your lender your enemy. But I do want to talk about some of these terms, why they come up, where they're coming from. And maybe, Xiao, we could start with you on, what do you think are actually, like, what are some of the predatory bridge loan lending terms, other things that you've seen as watch out, that you would recommend founders never take in some of their first debt positions?
Yeah, I think I've been fairly lucky because I know great people, like a lot of the folks on the call. I've never actually seen a lot of predatory lending here. It's the process you go through, right? Like the same thing as if you're buying a house or buying a car, you want to talk to a couple of different folks. You want to talk to other founders who have worked with folks for a long time. Again, I think a lot of this stuff is personal. It's relationship based. If the people you work with have supported your fellow founders and have done good things through thick and thin, you're likely to see some positive things. And again, it's also kind of a small community, right? There's not a list of like 10,000 lenders here. There's a list of a couple of trusted institutions, and maybe they vary in personality depending on who you're working with. But we're also very lucky in the major ecosystems in the United States. People tend to be pretty awesome. Don't respond to that random LinkedIn, tweet or LinkedIn message or tweet offering you money with 0% down. That's probably predatory. But if you're sticking with good people like the folks on this call, I don't think you can go too wrong.
I appreciate that. Okay, awesome. Then I think one of the questions that I hear a lot from founders is like, what are the fundamental drivers of my loan pricing as like the, bulk of the kind of terms and negotiations? But also a good founder asked me today, she was like, really, how does that change with milestones? Like, what milestones can I hit that actually change the fundamental calculus of how I can be negotiating that loan pricing? So maybe that's an awesome question. And Dimitri, I'm sure you've seen this with clients as well.
Yeah. Yeah, so from banking perspective, the pricing is actually pretty standard across most all venture debt. We do have all of these super complex pricing models behind the scenes that are related to actually the banking itself. So if you're bringing over $100 million and that's going somewhere inside of HSBC, sitting on a balance sheet, off balance sheet, all these different things that we're using as calculus that can help drive down that pricing. It's really interesting. You'll meet the founders who understand that relationship currency, and they'll be like, why don't I put 5 or 7 million more on balance sheet? How does that do for you? And you're like, yep, that'll take 25 basis points off the interest rate. So there are dials to turn, but most of it, the market is very competitive for venture debt right now. And I would say that it's by design, you're hopefully seeing very, very good, clean terms from a pricing perspective. Yeah, happy to dive into that deeper. Maybe I'll pause there.
I would say that, you know, a lot of, and I'd echo this, right? A lot of lenders have relatively tight ranges in which they can lend. So in our case, our range is public on our website. You can go, it's 15 to 75. Kind of primary drivers are just performance risk on the contract, how short or long the loan is. You know, in our case, our collateral is always the same. And so that's not a negotiation point for us. But for a lot of lenders, they can modify how much they take in security, and that will bring down your cost of capital. You know, how much you give up in warrants can potentially modify your interest rate. I was going to say, in terms of like, I wanted to come back to what Joe was talking about in terms of predatory lending. I think like the biggest things to look out for, at least in our experience, one is very high pricing, which is disproportionate to the risk. And you should understand what the market rates are before you like make that argument. But that's a thing to look for. Lots of fees. So a lot of lenders, what they'll do is they'll say, hey, we're lending you money at 10%. But there's all these fees. Don't worry about the fees. And then it turns out that there's like another 15% of fees. And we actually see stuff that's totally bonkers like that. It'll be a servicing fee, an origination fee, a closing fee, a payment fee charged on every payment, blah, blah, blah. There's like all this stuff. And so if people have a lot of complicated fees, that's a thing to be careful of. And then there's often there's kind of two other areas. One is how long it takes to cure problems. So really predatory lenders will have very short cure periods. So like if something goes wrong, you have 3 days to fix it. That's a thing to worry about, right? If a lender's like, oh, you have 30 days to fix it, it's much better, right? That's often gives you enough time. And then the last thing is just covenants, right? So just be careful with the covenants that are included in a loan agreement. Some lenders have a fixed set of covenants and they're very short. Like in our case, I think we have, I don't know, 5 or 6, and most of them are like, did you file your taxes? Do you have good standing in Delaware? Really simple. Other lenders will have really complicated covenants. What your debt to equity ratio is, how much capital you have in your bank account, how past due are you on payments to your vendors? Have you paid payroll every week? Have you missed like? And you just have to be really careful because some of those might not seem like a big deal now, but when stuff goes wrong, they can trigger default, and then it gives the lender power to do things that you might not want them to do. And so, but I think generally, you know, I give a lot of like trainings on debt, and there are sort of 6 criteria to think about in terms of things that drive pricing. And one is, you know, obviously the base rates that the lender charges. The other is sort of like fees. There's implied costs too. If the transaction is really complicated, you're going to spend a ton of money on legal. You know, we looked at a warehouse facility at one point for $100 million. It was going to have like almost $1 million worth of legal. Wasn't worth it to us, right? And we would have to spend that money on legal even if we didn't draw the facility. And it's like, that's also a thing to think about. Collateral is another, seniority is another, and speed, right? So one thing that a lot of people don't think about is like, oh, I can get cheaper debt, but it'll take me a year to get it. Or I can get slightly more expensive debt and I can get it now. And time has a cost, especially for a startup. So like in our case, we issue term sheets in a week, we fund in a month. Bank lenders, some venture debt lenders like HSBC, I think you guys are really fast, right? It's like maybe 30, 60 days to do a deal. Some banks, it will take them, like, you want to get an SBA loan? It's going to take you a while. And so it's cheaper money, but it takes a long time, has more complexity to it, more collateral, often requires a personal guarantee. That's another thing too, to be really careful of, is personal guarantees. Because often, yeah, you're betting your house or your personal assets on your startup is generally not good.
Thanks. Those are that personal guarantee is definitely, I've seen that offered to pre-seed founders that I've worked with in the past. It's pretty tough. I often see that more coming up when, you know, people really want to support, but it's more in the bridge loan scenario, or some kind of risky kind of manufacturing loan. I think, you know, there's a couple different ways that founders can think about being proactive about some of those terms, right? And this comes back to all of the conversations that we just talked about with lenders and really understanding early in conversation from that diversity of opinions. Luke, I want to come to you here about kind of pricing on the equipment financing side, any other terms that are involved, and then Austin, maybe you could teach us about warrants after that.
Yeah, I think, from an equipment financing side, again, with our structure at Camber, right, speaking to our process, it's pretty darn simple because there aren't a lot of the other restrictions that, Dimitri just rattled off, right? There's not going to be any covenants in there. There's no cash covenants. There's no warrants that we're negotiating on. There's no personal guarantees, right? There's not even a blanket lien on the company. We're just focused on the equipment. There's not really even an interest rate, right? Because it's a lease, not a loan. And so what our pricing, the biggest lever dial for us is term of the lease, right? More often than not, the longer the lease, the better for the company, because they're just paying back less monthly, right? They're pushing out their cash flows, they're pushing out their cash runway. That's what they want to do. How a company gets a longer lease with us is really, where are they at from a cash flow? How much they have in terms of runway? Are we already working with them? Do we have 2 to 3 years of relationship with them? If so, great, right? We already know them. We know they're going to pay us back monthly, and we know them. Like Austin says, it's sometimes, a lot of talk until you actually get into the relationship, but the diligence test of your eyes and the relationship and actually knowing and meeting somebody, that's how you get a longer term. In terms of our leases, that's how you get better pricing and better financing and potentially a bigger lease line versus where they're probably at from a raise perspective or things like that. But our pricing is actually relatively simple, because there's not that much to negotiate on in terms of the restrictions. So really what we're trying to do is, in a perfect world, if this was, if everybody was Apple level credit, we'd get, hey, we're going to use this equipment for 10 years. Here's a 10-year lease, and we'd match it perfectly, right? But we're not there, especially in the companies that we're working with. So it's like, okay, how can we match what we're looking at from a credit perspective with what they want to use in the equipment and try to pull something together that, hopefully is a good starting point, and then grow the relationship from there. So it's pretty simplified, but at the end of the day, we're always looking to try to match what they want and then grow to in the future, instead of having a bunch of transactional, hey, we're just going to finance one forklift and be done, right? It's like, no, we'll start at the seed or the Series A or kind of where they need, and then hopefully grow with them to a point where other doors are open. Their credit has changed. Maybe they're going to Austin, and he's got a plethora of options he can offer them, right? And the banking site, can we still be a fit? Absolutely, right? But we help in that earlier stage, and that's where we can hopefully create longer leases, which is kind of better terms for our companies.
Yeah. And I'll jump. So you had mentioned also terms to consider that are unique. So there's, I think, one thing that a lot of founders get kind of have to learn about or work through in the loan docs is this material adverse change or investor abandonment clause, which I think we've been talking around it, but this is in the loan docs when it says like everybody is friends here, and that matters to us. So one of those things is, a lot of people say, well, this allows the bank to kind of like, do whatever they want when they choose. And I think a lot of that, I think it's just worth mentioning, like the reason that these folks are sitting on the panel is because like the reputation risk of actually doing that at the wrong time is massive. Like one decision made by one of myself or my colleague, like that will like remove us from a lot of deal flow across the entire industry if you do that wrong. And so there's a reason why we always create equipment carve-outs when Luke calls. Like there are reasons we do that. So I think that's just worth highlighting. That those terms, like we're very open to share kind of the dynamics, but if a founder on the next day after we close the loan like wants to start an ice cream shop, like I think everybody around them has to be supportive for that change. Like you mentioned, Hannah, like the docs they evolve as the company does too. From a warrant perspective, so really the way that the bank looks at it is for venture debt, we will always ask for a warrant. There is no non-warranted venture debt. Hannah.
Austin, what is a warrant?
A warrant is the right to convert to equity in a liquidity scenario. So effectively, it's kind of one of these things, like the bank is not good at holding equity. Like there's kind of all these regulatory reasons why we would want a warrant instead of the equity itself. But what happens is at the liquidity event, if we are in the money on our warrant, which will define the strike price versus the common price, or we do common or preferred, but the price at that liquidity event, if there's a margin there, we do what we call a net cash exercise, which means it's just the difference between those two numbers, and the amount of shares we have is what we receive in cash when that transaction happens. We can receive equity as well, as it relates to like an equity type of acquisition instead of cash. But usually we see warrants getting converted into cash more often than not. So that is a warrant. And it is usually included in a venture debt deal. The only time it's not is if there's a covenant, which is there's negative covenants, and then I guess these are positive covenants, but there's a financial covenant, which would then be the thing that takes away the warrant component. That covenant, though, like, we're very honest when we're talking to companies. We have a lot of companies that say, why don't we just put a covenant in here? I don't want to pay a warrant. The challenge is I also don't want to be the banker that has to take the loan away or change, like get in, like when somebody breaks the covenant, that's immediately what we say to ourselves is, when you breach the covenant, what will we all do in that scenario? And if it means that I'm going to kind of do the same thing I'm doing with venture debt anyways, let's just take the warrant. Let's agree that like building a startup is messy and we're all kind of along for the ride when you have a small equity position. So that's usually kind of how we're usually talking about basis points. And from a banking perspective, the math that we're doing on our side is that the warrant performance on 1 or 2 of the 10 loans that we're doing will hopefully pay for the loan losses for the 1 to 2 to 3 loans that did not perform in that kind of cohort. And our goal is to actually just break even on all of our venture debt portfolio across all of our loans, because now we have more banking relationship. So it's actually, we kind of call it like our freemium product, because it brings companies in and then allows us to give them all the other solutions when they break out.
Nice. On that, I work a lot in the kind of like first of a kind, you got to blend together lots of different capital to put that first commercial, very technically risky, way too much dollars in CapEx for Xiao and I to like fully shell out on those. Like it's a thorny space. We've talked a lot about it in this series, but Austin, do you see folks using venture debt for development costs or the early project kind of equity spend of those projects?
Yeah. And Hannah, I think you mentioned it earlier, like what are the milestones that could unlock more debt? So the bank, as we can create more and more structure, can either reduce pricing or increase the size of the facility. And so the closer and closer you're getting to project finance, the more excited we get to deploy venture debt. So we can get those larger and larger quantums as you're kind of transitioning to that. What I would say from a project, like we've all been talking about, like that's when things get really expensive, but really big, and they take a really long time. So there's a lot of founders, I think we've talked a lot about this kind of in the market, but like Silicon Valley meeting the Rust Belt, like needs to happen earlier in a company's life stage than it is now. We have companies that show up and they're like, I'm ready for project finance because like I just got my first offtake. And you're like, put us in the diligence room for that. And they're like, what diligence room? And I mean, we can introduce you all to our project finance team. Like the level of diligence required for that stuff is bananas. And so again, we want to live on this transom of capital availability and know that no startup is just like jumping from one to the next, like without any kind of, gaps in between. And a lot of what we're trying to do is smooth that out with venture debt sometimes to say, we know that these milestones will open the door for that. But there's a gap.
Yeah. This is what Mark 1 steps in to serve, is a lot of that expertise, the structuring, the holistic assessment of risks for project development when you're inflecting from technology development and your equity cap tables. So we spend all of our time thinking about that, Austin, and I couldn't underscore more what you've been saying here. it is a much longer process. And it is, part of this is about how are you packaging and communicating about perceived versus real risks in the process, and understanding how your lenders will receive them. I think the other undercurrent that we really haven't picked apart in this conversation is, we're talking about covenants with very specific timelines and thresholds. We're talking about, debt service coverage ratios, very specific accounting, making sure you're keeping track of who's got where. Like, there's an aspect here of there's a level of professionalization within the organization, no matter where they are in that continuum, to have financial controls, to keep track of these legal documents, to understand that when you're taking on specific negative covenants, right, and you agree to those documents and you reach signatures, even though no one wants to get to the pedal hitting the metal there, like, you have to like, founders have to take autonomy and responsibility for not running it too close. And you kind of sacrifice some of those privileges of like running fast and pivoting hard with equity, but not so much when you have to have certain coverage ratios to protect these covenants, and not flirt with them. Maybe Xiao, Dimitri, like, how early do you see those teams changing a bit? Xiao, like, when you see folks taking on debt, like, do they often have a CFO, at a minimum a VP of finance? Can they get away with a fractional accountant? Like, how does that typical maturity look from your side?
Yeah, it's a great question. Obviously, every single business is very, very different. And so you really have to be hyper specific to what the company actually looks like. If the end goal is to develop like $100 million projects, then a very, very different kind of org needs to be built, with people familiar with infrastructure style financing, CFOs who understand the creativity around financing around that stuff, people who understand things like surety bonds and how conservative folks are to put any dollars at risk when things like happen, people who can underwrite like scrap value of like metal boxes. That is a completely different shape than, say, hey, if you're selling, small robots that need to be financed in a very, very different structure. The org component oftentimes turns into this sort of exploration of people, in that you want to understand usually the handful of people, 5 to 10, that have done this kind of work, that have financed these kind of projects before for some kind of analogous company. And then you try to bring that talent deep within your own org so that they can hopefully show you and expedite the process in which you build a world-class financial organization that is capable of doing the financial building that is necessary to accelerate your growth. Finding those unique people that have this experience, because again, there's not a whole lot of folks that really do this at a really, really high level. That oftentimes becomes the secret sauce. You can also find the people in this room, the people on your boards, the folks that have tried to put together similar kinds of deals in the past, and that can really de-risk the process as well.
Yeah, fantastic. Sounds like you're saying that happens kind of as early as possible in some ways.
It really depends on the specific growth trajectory. Typically, if you know you need to build a first of a kind plant, for example, you want to really make sure you prepare for quite a lengthy ramp to that. Hiring people is slow. Building the muscles and the experience is oftentimes slow. You probably need more than 4 quarters of lead time to really do that extremely well. Versus something a little bit less ambitious, such as doing just a slightly different and more creative kind of financing. That could come a little bit closer to the date. We typically see people starting to look at this very, very seriously at the late Series A. And again, I don't want to make too many of a generalized statements, but certainly by the time they're in Series B, we want to see that financial organization built up in a fairly mature way.
I'm
Absolutely.
going to take a slightly more aggressive posture, partially because I'm selling business, but also because I think it's good practice. So I think oftentimes entrepreneurs wait too long to professionalize their financial organization. And it doesn't mean you have to hire a $500,000 a year CFO who like comes from your industry. That's not what we're talking about. I think that generally, as soon as you take anybody else's money, that is the moment to start professionalizing your financial organization. And that includes like friends and family, right? So you do your pre-seed round, you raise $1 million. Cool. You need to have good accounting in place. You need to have at least a simple operating pro forma that tracks performance to plan. You need to have a plan. It could change. Some companies adjust their budget every month. Some companies set their budget for the year and then track performance. Both are fine, right? But I think, yeah, Dave's right. Exactly. I think in general, there are sort of like table stakes, right? So the first is like, can you effectively understand how much money you have and how much money you will have at a point in time in the future? That's a fundamental basic requirement for any founder. And I cannot tell you how many times people come to us and they're like, hey, we want to hire you to help us with our finance back office because we thought we had 9 months of runway 6 months ago and we actually only had 3. And it's like, that should never happen to you as a founder. That is just like not a thing that should happen to you. That's a fundamental failure of an entrepreneur. And so there are these like basic things that start very early. There's accounting and there's what we call financial planning analysis. So budgeting, pro forma, metrics. And then as you get more mature, if you want to go after different kinds of capital, then you need to have that expertise. Now, that expertise can come from a fractional resource. It can come from an advisor, although I would be careful there. You want to make sure they actually know what they're talking about. They're incentivized to give you good advice. If you don't have those resources in-house, get them sooner than you think you need them. Because the last thing you want to do is you're like, oh, I need to raise this thing in 3 months. That's too late to start looking for someone to help you do it. And then I think to Show's point, like if you're building a business that requires complex financial engineering, which actually a lot of climate businesses require, don't make that your last hire, right? Like it is sometimes just as important to have a VP of finance who understands how projects get financed as it is to have an engineer who can actually design the ship.
Yeah, 100% right. And to Dimitri's point, we're very lucky to live in an era where it is easier than ever to do this well. There are a lot of great tools and apps where you don't necessarily need to build a 3-person team. Like these tools are fairly sophisticated and they just have to be right for the stage of the company you're at. If you're a pre-seed or seed stage company, you should be using one of the leading software programs to help manage your budget. And then as you graduate closer to the Series A, you probably need a dedicated person looking at FP&A. Right. And this idea of like what your VP of finance does will also evolve over time. In the beginning, just to make sure they do everything that Dimitri mentioned really, really correctly, more on the FP&A side, that's great. And then you graduate towards to a more fully fledged creativity style CFO down the road. But it doesn't have to be so crazy. And I think to your point, Dimitri, some founders probably don't understand actually how easy it is to actually get more sophisticated and have more information at their fingertips, which then leads to them making better strategic decisions for the business itself.
Yeah, I would actually to that point, like it's almost like the cost of operationalization, that's a tough word, versus the cost of capital. So like if that operator sits in that seat, that gives you access to a different cost of capital, you've now kind of paid for that individual and more. And like from a bank's perspective, first thing my credit officer asks if we're putting like a financial covenant on a deal is like, who is managing the finances? Like if it's the CEO and they're just, to your point, Dimitri, like they can't look at it all the time. Like it's how much energy is actually being focused on this part of the relationship, because that will affect the cost of capital. So.
Absolutely. And I in our last 3 minutes here, I want to encourage our attendees with a thank you for joining us and sticking around. Over 100+ of you in the room today. Incredible. Please drop any last minute questions. We can sneak them in. And Agneta, I love that your question went exactly where I was taking this next, which is like advisors into fractional CFOs, into much fuller team members that could start with a VP of finance, and then the creative CFOs. Like that's often the trajectory we track and see. And those operators are very interdisciplinary, right? Don't let them get too complex too quickly. A lot of the most elegant solutions are the most simple. You should not be having securitization or downstream monetization within your products too early. Like get the fundamental business model right. Like cash is king, but focus is certainly queen in a lot of those ways. And I think, the debt component is also a privilege. It's got its purpose as we've covered today, but it's a privilege, right? It is a maturity for the business. It's that vote of confidence, and that comes with maturing the team alongside it. I don't see many questions coming through the chat, so maybe I'll ask my last one to Xiao, which is, Can you talk to us about, for many of the founders in this room who are at the varying stages, probably between seed to Series C, and are actually at the point where they're purposefully putting debt to work in between equity rounds? How do equity investors think about corporate debt coming from Luke, coming from Austin, coming from Dimitri within the subsequent rounds?
I think if it's applied correctly, debt could be a powerful de-risking of the business. And like with all things, you have to blend it into the overall vision and the story of the business because, we're venture capitalists. We love a great story. But if you are able to incorporate in a way that both says, one, this business is about to get a lot less dilutive, right? I don't have to throw in another $500 million until this goes IPO or some other fantastic result happens. Great. That makes me more likely to consider a very, very different set of valuations for this kind of business. But also secondarily, I'm looking at overall cost of capital for the business to mature and to grow. And you're essentially telling me that now you have access to a much, much cheaper tier of capital in which to really build and have as the core ingredient of this business. The storytelling is really, really important because there's also kind of this moment where the reality of the business becomes apparent, right? Are the economics as real as we said in the seed stage, right? How does that translate into how fast the business can grow? How does that translate into how much money the company can digest? All those things kind of become apparent when you start to have to work with debt. And so you always have to be really, really conscious of what the numbers actually indicate and then tailor your story appropriately. But overall, if used properly, debt is a really, really amazing thing. And we're lucky to live in an ecosystem where you have access to all these different forms of capital.
What an excellent note to land on in that gratitude. With that, thank you, panelists, and thank you everyone in the audience for joining us today. This was special.
Thanks, everybody.
Really appreciate your
Thank
great
you.
moderation, Hannah. Thank you so much for leading us.
And notes will be published by early next week if we can get our stuff together. Thanks, everybody.
Thanks. Bye.